Welcome to an episode of the Mentorship. In this video, we're going to be looking at the intraday model. So in the last video, we went over the start or the first example of the swing model. As you could see, it was this live example. And today's one, we're going to be looking at another live example, but this is the intraday model, how to construct it and how to do it step by step. So there's one thing, they're both very similar, both using outlooks, but obviously we're executing on a slightly different time frame, and I would say the intraday model has a little bit more to it. Why? Because when we're trading a little bit slightly lower time frame, obviously we're still not trading very lower time frame, 5 minute, 3 minute, 1 minute, but because we're still trading slightly lower time frame, 15 minute, 30 minute, there's a little bit more to understand and look at before we actually execute the trade. So firstly, we always start with the daily bias, daily outlook. So you're going to see in this video, which I'm going to show you, how we actually plan the trade. This is very, very important because it all starts from here. But in this video, we're discussing what happened on that specific day. It was a CPI day, and we've seen a higher time frame drawn liquidity being swept, and we're looking at potentially a reversal for the next day into a higher time frame array. So you'll see this video and then I'll come back and show you how we construct this and actually take an intraday trade the next day. So market update, this is a daily outlook, I guess, for tomorrow and potentially for the rest of the week. So today, obviously, we had CPI news driver, and then tomorrow, as we know, we've got PPI. So this is usually where I kind of like to then go back hands-on to the market. After CPI news release, PPI is usually quite a good driver in terms of actually taking trade setups. So what happened today was interesting. We actually did manage to get the correct draw. However, it didn't really allow us an opportunity to really execute anything. So this was CPI news release at 1:30. We ended up taking out lows on the 4-hour chart, which is really what we waited for, just the news release. And if we check the weekly chart, as you could see, this weekly high actually has now got taken. Now, as we said in the outlook, the last outlook, obviously the next draw is going to be this high over here. However, we know whenever highs, any sort of highs and lows are taken, it could be an opportunity for some sort of even slight pullback. So we have to be careful with that, and we don't want to get caught offside, So what I could see right now, obviously, is if we do potentially on PPI or before PPI show signs of trading higher without really any sort of pullback, without any disrespect of this array. So what I mean by this array is just this whole area that actually caused this move. If we look at the hourly, as you could see, this hourly fair value gap coincides with the 4-hour order block. If we get some sort of reaction in here and then we trade higher, probably be a good idea to continue DXY buys. But if we don't, then I would then start to be a little bit I would be a bit cautious actually because of the amount of liquidity that's been taken here. Let's just see how the market holds at this area. Do we close above, giving better indications that price is going higher, or do we wick in, come into here and disrespect? If that happens, then it kind of changes the script. So we'll see what happens from here. The first step was doing the daily outlook. So after we've done the daily outlook, then we're looking at the bias. So if we look at the chart now, we're going to show you the chart, and I will just show you simply just the DXY for now and the daily time frame. So as you could see, as a whole, after CPI or on CPI day, we have taken out buy side liquidity on the DXY chart. And in that video, we discussed that we are looking for a reversal because obviously we've swept out a lot of highs in the market. And if we go to the 4-hour chart, as you're going to see, or the 1 hour specifically on this DXY chart, you're going to see a big hourly fair value gap over here. Okay, we're looking for, I guess, a short-term reversal. This is why it's the intraday strategy from Higher time frame points of interest, obviously always looking at the daily, but also similarly looking at the 4-hour hourly for potential continuation / reversals and in general draw of liquidity. So we've had one draw, as we always know, draw to draw. We've had one draw being taken. As you've seen, this was the daily draw, right? And we have another draw in liquidity here. We're obviously in every trade planning a draw to draw scenario. So we've taken buy side liquidity. Can we fuel, because of that move, taking a buy side, can it fuel a move to take out the sell side liquidity? Okay, so as I said, as we could see, we're looking at a very, very simple trade. Draw to draw, DXY continued higher, as you could see on the left. But as a whole, we still took out that daily draw. And what happens after CPI? Usually the day after we get PPI. So there was another driver this day. And as I said, as a whole, we are not looking to trade before because we don't really have a bias yet. We want to see reversal, but at this point, there's nothing to prove that our bias is going to be right. So that's one of the main things with the intraday model. We'll do the daily outlook, but we're not going to trade. We're not going to say, okay, well, we kind of want a reversal and then just take a short. We need something to prove that we're going to take this short and prove a reason for why this short should actually take place on the DXY. So as you could see, the time now is about 1 p.m., right? So in the next 30-minute candle, PPI is going to come out. And as you could see, we're looking for confirmation for price to go lower on the DXY. But this is why the intraday model is just having a little bit more of an understanding of your surroundings, because as a whole, higher time frame, we want it to go lower, but as I said, we need confirmations for that to happen. So one of the best ways of using confirmation is looking at the different arrays. So we've marked out this fair value gap over here, and as you can see, let's play the PPI candle, right? And as we could see, the PPI candle has traded into this fair value gap and traded lower. This is a general sign that price is now respecting the bearish array and is actually moving lower towards our drawn liquidity. When did this happen? And that is very important. It happened on the economic news driver. Now imagine, this is why this is the perfect confirmation. Because imagine we just took this trade off the bat, price traded into this array and then traded higher. Then obviously we would not be looking at shorts on the day because it did not confirm price to be bearish. This is the perfect example of price confirming our bias, because it is now disrespecting bullish arrays. As you can see, there's another bullish fair value gap over here. What did price do? Price just completely ran through it and is now showing signs that it actually is going to our liquidity point over here on that hourly chart. Let's go back to the hourly chart and you're going to see what I mean. There you can see this hourly draw on liquidity over here. Okay, that is what a price is showing signs of. So that is the most important thing to consider here. Yes, we have displacement if we look at the 15-minute chart. Very, very beautiful displacement actually, right? But not only did we have that displacement, it was confirmed on news, it confirmed our bias, and it's disrespected bullish arrays, right? Price on DXY for this point has been bullish. Why is this showing a change to go bearish? Because it is not respecting bullish price anymore. And now what's it doing? Respecting bearish price, because we've traded into the bearish fair value gap and we're actually with volume displacing. What does that displacement look like if we go to the 15-minute time frame? A big solid push lower, right? And another great way to spot this displacement with a 15-minute fair value gap created over here. As you could see, big signs of displacement. We've also closed under this low. This is obviously, as you know, a market structure shift. When we close below the low, we're now making a move lower. And what it is, always going back to the daily bias, because the daily bias, we were looking for a reversal today. Why didn't we trade the reversal here? Because there was no confirmation. Why didn't we trade the reversal here? Because there was no confirmation. Over here is where we actually get the confirmation, and now we'll show you why this was all live, right? This is that same day, 14th of November, as you could see, trading in between two arrays after PPI, either looking for low of the day from lower point of interest, as you can see this fair value gap, or respect of the higher fair value gap confirming high of the day, easy points of confirmation. So it's the exact same thing that I'm showing you this example, except this was the live chart. So I'm saying if we come into here, respect it, and then go lower, we're looking for high of the day. However, if we stay in this array, disrespect this, and just continue higher, then obviously there's no confirmation. DXY is probably going to go higher. So then that's how we do it step by step. We waited for price to come into the array. Now, as you can see, I'm saying interesting. Let's see how we close now, right? And as you can see, what did we do? We closed as a wick. We start trading lower at this point. Now I say happy to call this a nice rejection on DXY because we're confirming that we're respecting this array and we should be going lower towards our draw on liquidity. So how do I get in line with this trade? Obviously, we're doing this on Euro USD. So we go back to the chart, right? And we look at Euro USD. What is Euro drawing for at the same time? Well, here we have Euro USD on the higher time frame with a 4-hour fair value gap, right? We are expecting DXY to go lower. So we're expecting Euro USD to draw higher. So that's exactly what we're doing. We did the bias on DXY. We're executing on Euro USD. They're obviously oppositely correlated. So this is what I was looking for on that day. And as you could see, this is the live chart at that time. You cannot fake this at 2:03 p.m. on the 14th of November. And I'm looking at Euro to trade higher. So step by step, we've got the confirmation on the DXY. Now we're looking to execute this on the Euro USD with the daily bias in line with that. So what I've done after that is I've got in line on Euro USD. So if we go to our actual time frame of execution, and as you could see, this was all from daily, hourly, etc. Right? We execute. I'll show you the position around over here on this after this 15-minute candle close. So that is around right over here, as I can show you on the chart again. Around here, we wait for one candle closure, we execute around here. So let's say around here, and we had our stop loss around here. Why was our stop loss around here? And as you can see, it's quite a decent stop loss. This is one thing with the intraday model. We have a generous stop loss. You know, a lot of people are going on lower time frame and doing something like this. They're like, well, I'm trading this array anyway. If it comes any lower, it doesn't really matter because this is what I want. No, we're either putting our stop loss at full invalidation or very, very close to full invalidation. I put my stop loss around here, as you can see. What did I target? That 4-hour array, as you could see over here. Very, very simple trade. And just for anyone wondering, why did we execute here? Exactly what I said. We're reading price on the DXY. When we seen the rejections over here, exactly when I've sent this message, happy to call this a nice rejection. This is exactly on Euro where I've entered. Why? Because it's that logic that I believe this is high of the day on DXY because of that confirmation, because of that rejection. If I believe this is high of the day on DXY, that's why I believe that this is low of the day on Euro. And if I'm wrong, I'm going to hit stop loss, then it was not low of the day. But if I'm right, then what is the point waiting any longer when I'm already told myself that I don't want price to trade any lower? I've got all the confirmation that I need. So it's a market entry. When we seen price come here on the DXY, right, over here in this array, we obviously closed here, we start trading lower. At this exact point, right, we have entered the buy on Euro USD. We are targeting the high. So we did not wait for limit confirmations on this intraday model. We executed around here, and all we're doing is letting price play out now. And as we could see, we hit full take profit very, very easily. And to be honest, DXY, I was on our favor this day. We picked Euro USD, hit take profit very fast, 2.2 risk to reward. So even though this is an intraday model, yes, we have exercised the use of the market entry, but I do want to say, make sure you're not doing your market entries too fast. A lot of people will see this and then just start doing a market entry every time they see something. Look at how much went into the market entry. And there's always one principle. Remember it before you ever take any trades with this model. You are looking for high of the day and low of the day. Obviously, reverse with DXY and Euro USD. on DXY, we wanted bearish price because of the daily outlook. We did not think that we seen high of the day here yet. So we didn't trade. We didn't think we seen it here. We didn't think we seen it here. Once we got the confirmation that price was not respecting this bullish array, we've traded into this array. We've not closed higher on the candle. We started trading lower, and we're starting to disrespect bullish arrays. That's when we decided that this is high of the day, and the logic behind it is all of those things, not just one thing. So a lot of people might just start executing for no reason as a market entry. And the other thing is, remember, we've always got a slightly wide stop loss, right? We are saying that this is invalidation. If price comes lower here on Euro USD and takes out this low, then at that point it would have taken the high on DXY. If price was to have taken the high on DXY, would it have then been likely to have been high of the day? No. That's why it's invalidation, because the reason we're trading is based off of the intuition and the market knowledge that this is most likely to be high of the day on DXY. So why is this invalidation? Because obviously if price comes higher than this high or lower than this low on Euro USD, then it is not going to be high of the day on DXY, and it's most likely not going to be low of Euro USD. That's why we give ourselves enough breathing room, right? A lot of people on lower time frame, they'll have a very small stop loss, and they'll end up getting chopped out of these moves that they could have won just because they didn't have a high enough stop loss. And as you can see, when we did finally get into the trade, we had a very, very clean run straight to take profit. Why? Because we traded the perfect move of the day. Why did we trade the perfect move of the day? Because we started trading when we actually seen volatility and displacement. We traded after the economic calendar showed its hand, and we traded in line with the daily bias. None of these things should be done without these things considered. Daily bias, economic driver, confirmations, 15-minute time frame, DXY, Euro USD, high of the day, low of the day, or low of the day, high of the day, and we execute. It's very, very simple. But if you don't do it in this strict process, you might end up market entering random places for no reason, and you're going to end up losing. But as you can see, very simple model, and that's how we did it live. And as you can see, this is all based off of that outlook. On the 4 hour, we said we want Euro USD to draw into here. Obviously, if we go back to the actual chart and you look at Euro USD now, what happened? Exactly what we wanted price to do, right? So don't think about it as if you're trading the 15-minute or you're trading the 30-minute, etc. You're still trading the daily, the 4 hour. You're using the 15-minute as an instrument for that bias, right? That's why we wait for those confirmations, but we're still doing exactly what we did in the live outlook, and it was perfect. As you can see, this was the live position, and what we did was we hit final take profit, as you could see, and Euro USD had hit our target. Very, very simple model. Very easy for you guys to replicate it, but remember the step-by-step process, because if you don't, then you're going to have a very, very hard time understanding high and low of the day. But that's the biggest principle, and understand the concept of displacement. And if you need to rewatch the video a few times, you can, but this is a big, big principle. As we were looking at confirmation, right? How did we get the confirmation? Because we're saying if price respects this array and goes higher through this array, it's obviously going to be bullish. But if price comes into this array and starts displacing lower, then obviously we're going to be bearish. That's what we waited for. You could say, well, we're saying if for anything. That's fine. But we actually execute and wait on that plan, right? Let's see how we close now. We waited till we seen the close. Price started trading lower. Then we're saying we want to target this on Euro USD step by step. Then we get into the position on Euro USD. Then we obviously hit take profit and Euro hits its gap. Very, very simple, step by step. Hope you guys enjoyed the video. If you have any questions, let me know. So one final point I wanted to say before I ended the video was one common question, and I think that it will be summed up from this video. So I thought I'd add it in. A lot of the time people ask, do we trade London session or do we trade New York, or when would we do either? So number one, we trade either London or New York session with the intraday model. With the swing model, as you should know, or if you don't now, you know. And swing model, because it is higher time frame, it will be obviously spread out over multiple hours. So it doesn't matter if I entered in Asia or London, Because it's a higher time frame chart, it's going to spread over multiple sessions or multiple days. So the timing of when we execute the swing position, obviously after we have confirmations and the trade looks good, it doesn't really matter that much, right? However, with the intraday model, you're not specifically going to trade London or New York. What you are doing, just like in the video, is you're waiting for the daily outlook. So let's say there's a day where I'm looking for DXY to trade higher, right? London session comes and it's chopping around doing nothing. Are we going to trade London for no reason? No. Now let's say it comes to the New York session, just like in this video, and DXY now shows its hand, starts trading higher. That is when we're going to trade, because the daily outlook is that's what we're trading, right? Similarly, if we have a plan for DXY to go lower on the day and it's London session, all the confirmations are there. It's made a clear high of the day because we want DXY to trade lower, for example, yeah? And London's actually making that move. It showed the confirmation. Then in that case, we're going to trade London. So the answer to that question is just like you see in the video, it's because of the daily plan. If that daily plan has showed its hand, showed its confirmations in London or New York, we will trade either of those sessions, and usually it will be one or the other on the day, because the bulk of, obviously not every day is like this, but the bulk of the expansion usually will happen in one of these sessions, and we're not going to limit our move because we're already limiting a lot of moves by trading 15-minute, 30-minute. Why? That's a good thing, because we take a lot less silly premature positions because we're trading a little bit higher time frame, 15-minute, 30-minute. We're usually catching the bulk of the daily range. To catch that bulk of the daily range, we're using the daily outlook. Then we come back, execute based off of the confirmations, which will either happen in London or New York or both. Okay, that's a little bit rarer of a cause. And obviously, if we want to trade that morning in London and New York shows its hand, you don't obviously have to take another trade because you're out for the day. Every time you enter the market, you're in with more risk, right? So a lot of the time, London will do nothing. It didn't show its plan with the daily outlook. It didn't show any signs of high of the day low. They didn't do anything. Skip London. That's what you do. Our model is very mechanical and simple. If the daily outlook is not showing its hand, it's not got anything in line, just like you see in this trade. When did we take it? After New York session, after PPI showed confirmation. That's when we took it. So we don't wake up in the morning and say, I'm going to trade London and New York. You say, I'm going to trade my daily bias. And when that happens in the kill zone, either New York or London, that's when you're going to take the trade. So hope that clears up anyone who had that question as well.